Today, is a 5% Fed rate on the cards? Hello again, it's Martin North from Digital Finance Analytics for the latest post covering finance and problem news with a distinctively Australian flavour. Well, the Dow slipped into the red late on Wednesday, pressurised by a Micron-fuelled slump in tech and heavy losses in retailers, just as better than expected retail sales data renewed fears of more hawkish Federal Reserve monetary policy tightening. Wednesday's market pullback came after a hefty rally stoked by softer than expected US inflation data that had fanned hopes the Fed may be able to slow its tempo of interest rate hikes. While a slew of Fed officials in recent days have backed those expectations, they've also emphasised the need to keep hiking into next year. Consumer spending is proving largely resilient in the face of high inflation and steep interest rate hikes from the Fed that are dealing a sizable blow to housing and squelching manufacturing. The Commerce Department reported that retail sales rose 1.3% last month, topping estimates of the 1% gain expected. The Retail Sales Control Group, which has a larger impact on US GDP, rose 0.7%, beating expectations for a 0.3% rise. Retail sales, a measure of household spending that is the powerhouse of the nation's economy, charged ahead in October, with the biggest gain in 8 months. Meanwhile, more interest rate sensitive sectors like housing and factory production continue to show signs of weakness. The sales figures show that the Fed's inflation fight is far from over as it tries to restrict demand, but also indicates firms spending that risk keeping inflation elevated for longer. While many central bankers judge it will soon be appropriate to slow the pace of tightening, their task is complicated by the steadfast consumer. In fact, the Atlanta Fed GDP Now forecast for the fourth quarter moved up to 4.4% from a previous estimate of 4% after the stronger retail sales report. The stronger than expected data potentially heightens the risk of a downturn if it's met by even more punishing interest rates, according to Wells Fargo. It's tempting to cheer on the resilience of the consumer, but the staying power of spending gives businesses no incentive to forego price increases, thereby making the task of getting inflation in check more difficult for policymakers, Wells Fargo's Tim Quinlan and Shannon Seaney said in the note. On Wednesday, New York Fed President John Williams bruised sentiment after he said that the central bank should avoid incorporating financial stability risks into its consideration. And San Francisco Fed President Murray Daly, meanwhile, stressed that a pause is, quote, off the table. Goldman Sachs now expects the Fed to boost its key rate to a range of 5 to 5.25%, up from the previous call of 4.75% to 5%, and they added another Fed hike in May to their forecast, in part due to what they see as some risks that consumer spending could reaccelerate too much. The strong data is a decent indication that nominal demand remains fairly robust, suggesting that the Fed still has more work to do to bring it in line with aggregate supply, said Jeffries. So the Dow Jones Industrial Average slipped 0.1%, the Nasdaq fell 1.54%, and the S&P 500 fell 0.8%. Target fell 13%, pushing the broader retail sector deep into the red after the retailer reported a 50% slump in profit and cut its fourth quarter guidance, warning of a weaker holiday quarter. And Lowe's climbed 3%, bucking the trend lower after reporting third quarter results that topped analyst estimates. Advanced Auto Parts fell 15% after reporting quarterly results that missed on both the top and the bottom lines, prompting a string of downgrades from analysts on Wall Street. UBS downgraded the stock to neutral from buy, while Wedbush cut its price target on the stock to $165 from $200. Tech stocks took a breather from their previous melt-up following pressure from a Micron-led slump in semiconductor stocks. Micron Technology fell more than 6% after the chipmaker warned that the market outlook for 2023 had weakened and cut capital expenditure amid plans to trim supply. We do believe there is potential for a longer demand trough that would potentially weigh on the broader technology space, e.g. a recovery that starts later in 2023 or is weaker than projected, Wedbush said following their announcement. And investors should remain defensively positioned despite the ongoing tactical rally in equities, said Morgan Stanley. The strategists are highly convinced that 2023 bottom-up consensus earnings are materially too high, hence the next leg lower should be driven by a revised 2023 EPS forecast. As a matter of fact, Morgan Stanley cut its 2023 EPS forecast by another $8 to $195 in the base case. This leaves us 16% below consensus on 23 EPS in our base case and down 11% from a year-over-year growth standpoint. After what's left of this current tactical rally, we see the S&P 500 discounting the 23 earnings risks sometime in the first quarter of 2023 via a 3,000 to 3,300 price trough. We think this occurs in advance of the eventual trough in EPS, which is typically for earnings recessions, so the strategist said in a client note. As a result, investors should stay defensive and seek to gain exposures to healthcare, utility staples, as well as defensively orientated energy stocks. On the other hand, Morgan Stanley remains underweight on consumer discretionary and tech hardware. On a more positive note, Wilson said that 2024 should yield a strong rebound. After the new lows were hit in the first quarter of next year, Morgan Stanley's price target for the S&P is $3,900 in 2023. The rally should be driven by the market beginning to process growth reacceleration well in advance. Despite the move lower on the broader market, some on Wall Street continue to bet that stocks will likely grind high into the year end, though the advance isn't likely to be smooth. We like the markets overall to push modestly higher into year end. However, this should not assume it will be a smooth trade, as macro uncertainty remains elevated even after some of the inflation data has started to cool, said January Montgomery Scott. The indices trimmed their losses after 4 p.m. when a fresh batch of earnings trickled in. Nvidia Corp posted quarterly sales that topped analyst estimates, while Cisco Systems gave a bullish revenue forecast. A closely watched part of the US yield curve reached new extremes of inversion, signaling continued concerns about the restrictive Fed policy and how it will sap the economy with the potential of a recession. The market is just trying to grasp for news, and it's prone to overcompensate for the news, whether it's good news or bad news, said Sandy Brager, Chief Client Officer at Aspirant. We're at the point in the cycle where we think there's still the high likelihood of a potential downward trajectory of stocks as we head into 2023. The stronger retail numbers give the Fed more room to be aggressive, as officials have constantly communicated. Oscar Arov, alternative fixed income head of market strategy at JP Morgan Asset Management, said the disparate economic data that has hit the markets in recent weeks complicates the central bank's mandate, she said. And elsewhere, European central bank policymakers may slow down their tempo of rate hikes with only a 50 basis point increase next month. So you can see here that the markets are still feeling their way, trying to work out where to go. But the risks, the downside, still seem to be there, and the sales figures really underscore that. Therefore, expect higher Fed rates. 5% does seem to be on the cards. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer.